So US multinationals hold right now, or have right now, about $2.6 trillion in what is called unrepatriated foreign earnings. So these are the earnings that are reported on their financial statements to the shareholders. These are public numbers that are reported as so-called permanently reinvested abroad. So they're not bringing those earnings back. They're not subjecting them to US corporate income tax. There is a lot of talk about imposing some kind of a one-time tax on these earnings, and it's part of the administration proposal that was released yesterday. That tax on these earnings has two objectives. Both come with caveats. So the first objective is revenue. Even if you impose a relatively low tax, like 10%, on 2.6 trillion, that's, 260 billion. There's probably going to be foreign tax credits, so let's say 200 billion, right? That's a lot of revenue. The problem with that revenue is that current reformers are planning to use this one-time revenue to pay for permanent tax cuts. And that's a problem, because sooner or later this revenue is going to run out, but the lost revenue from tax cuts is going to be there. The second objective is to stimulate growth here. The idea is you allow the multinationals to bring all these earnings back into the country. They will invest it in jobs. They will invest it in R&D, in plant and equipment, and so American economy will grow faster. There was a tax holiday about 10 years ago where American multinationals brought back about 300 billion of these unrepatriated earnings. And so economists had a chance to study where the money went. And the money did not go into jobs, into plant and equipment. The money basically went into two things: stock buybacks and mergers and acquisitions. So some companies buying other companies. So there's not a lot of hope that we're going to stimulate growth by imposing this one-time tax. We will raise revenue, but if we pay for permanent tax cuts, that's not going to work very well either.